Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. LiveSquawk Market Talk, our weekly review of the markets on Friday, the 23rd of January, 2026. For anyone new to this podcast, every week, myself and guests break down the key stories of the week and look at the implications for the markets. We'll also preview the week ahead, providing you a heads up as to what you should be looking out for. This episode, I'm joined by regular contributors and long-time traders and brokers. Ryan Littlestone of Forex Analytics. Hello to you, Ryan. How you doing?
Hello, mate. I'm all good. How are you?
Very well, thank you. And Michael Brown, market analyst at Pepperstone, the spread betting, CFD and Forex trading broker. How are you?
Very good afternoon to you, mate. Happy Friday.
Yes, happy Friday. As we're recording this, just ahead of the US cash equity open. Anyway, I'll bring you both in shortly, but before that, just a quick disclaimer. The content on this channel is for educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. Okay, now, if anyone can hear any drilling in the background, I apologize. It's they decided to do some building work on next door. So let's get into it while we can still be heard. The week that was, then we'll crack on through this because it was one of those sort of weeks really where anything and everything could have happened. And we'll start with the diva in Davos is how I put it, and the talk of the town.
Have you trademarked that yet?
No, but I think I might. I think I might actually. Talk of the town was President Donald Trump, who flew into Davos, the Swiss resort, for the annual World Economic Forum, and really just took over the place with for the time he was there. Right. Actually, we'll start with Michael because we'll come from the sort of macro fundamental perspective first before we get into the trading and the effects on that. What did you make of the US president and what he had to say and its relevance to the markets, Mike?
Oh, well, I mean, where the hell do you start? I guess the focus for everyone this week has been on this whole issue of Greenland primarily. And it's just another example of, we've had a year of it now. Escalate to de-escalate, throw out a threat, focus some minds, get people around the table, get some concessions out of the other side, reset the narrative, and ultimately achieve a deal in shorter order than would otherwise have been possible. So, I mean, yeah, it's not the sort of modus operandi, it's not the status quo that we've been used to for many, many years, if not decades, but ultimately, this is how Trump operates. We should be relatively wise to that by now. And I guess from a market perspective, it's kind of been a week of two halves. We started the week with concerns over, is this going to be another tit-for-tat trade war? Are we going to have the EU retaliating with tariffs of their own, et cetera, et cetera? And we end the week pretty much back where we started. Risk is rallying again, and everything is sort of right with the world as far as the market's concerned. And you just think, surely by now participants should have wised up to the fact that the sort of bull in a china shop approach, the maximalist approach to negotiation, is just how this is going to work.
But isn't this kind of how he works in terms of that, by unnerving everyone? It's always on his terms, on Trump's terms, and actually that's
absolutely,
that's the way he does things. But for the market's perspective, we haven't seen that fatigue really, that initial fatigue that we would reaction wise that we you'd, like you say, we should probably expect. How, from a trading perspective, do you handle this, Ryan? I mean, what do you do?
What do you do apart from sit there and watch it with a bag of popcorn?
Yeah.
There's two things you can do. You can judge, how real the threat is. He loves coming in, starting a fire, putting the fire out, and telling us how he saved everyone. So you look at it from the perspective, okay, is he really going to invade Greenland? Because you've got to look at it. The market's always going to get, too extreme about things. It's going to get too fearful. It's going to panic. The algos are going to get into it. But as a trader, you have to look, what is the likely outcome from this? The likely outcome was always going to be he's going to threaten, but then get some sort of deal done. So really what I was looking at, and really you could sum up the whole trade with pretty much two comments in that speech that he made. He went on a waffle, obviously. I'm glad I bought his Trump speech minutes at 60 because that's settled at 83. So that's probably my best trade this week.
Good buy. That's a good buy, that was.
That was a good buy. But
That's his best trade of the week.
Exactly. But it came down to those two comments that he issued, that he wasn't going to take military action to get Greenland, and that he'd, pretty much already started negotiations and whatnot. For me, that was a green light. I jumped into bought stocks, bought SPOOs, and that was it. I haven't looked back since. And that's the way the market's gone now. We're over that hump. They're talking about it. Yeah, everyone in Europe's, they've been given their nose poked, their eyes poked. They've got the hump with him for the way he went about it, but who cares? He doesn't care. And that's for them to deal with. And I think, we're over this hump, but we've still got this underlying theme going on of everyone's calling it the rebalancing out of the US. I don't think that's going to go anywhere too fast.
Well, I think that's interesting, actually. Sorry, Harry, just to jump in, is, as I said, week or two halves, stocks have bounced back to basically where they were this time last week. Treasuries have bounced back to where they were this time last week. The one asset that is still under notable pressure is the dollar. And actually, the dollar index, I'm just mentioning it because I know Ryan loves it, is, as we speak, trading at its lowest levels of the week. So there is still that kind of cautiousness about going back into the US as we were before this latest escalation.
Yeah, and you say yields have pulled back a bit. If you look at tens, we broke that 420 area, and we haven't really looked back at that. And the situation's changed when you're seeing US yields going up, but the dollar going down. So we know the trade that's going on there still.
And I mean, this is being chipped away. It's like water torture. This is a drip effect on US assets, from what I've read elsewhere. And it's never one situation, but he's undermining. This is what I've read. He's beginning to undermine the US asset, and as the be all and end all. It's not going to get replaced anytime soon. But everyone's going to start looking at, maybe when the bonds expire or whatever, and we look at new bonds, that they won't be as keen to get into US fixed income as they might have done before by US Treasuries, for example, and they'll look elsewhere. I mean, we've read theories on this at the moment, and we haven't really seen any great way. But is there a real fear, do you think, Michael, that is eventually where we get to, where people just go, I don't need the hassle of owning being so heavy in US assets, and I'll start to rebalance it out a little bit more?
Yeah, I think there's a line that needs to be drawn between diversification and not having any exposure to the US at all, because certainly with these larger funds and pension funds and even state investment funds, whatever it might be, the treasury market is simply too big and too deep and too liquid to ignore. However, having said that, there is and there will now be conversations taking place as to, do we further reduce our exposure to the United States? Because remember, this isn't really a new theme. I mean, arguably since last April and all of the Liberation Day shenanigans, people have been trimming what was a massively overweight US position that they've had for probably a decade or a decade and a half, maybe, if not longer. So I think it's more of a kind of continuation of a theme that's been in place for a while now. But it's certainly something that, the developments of the way that Trump is acting, although it yields results in terms of getting a deal done or getting a negotiation sorted and giving risk the all clear to rally once again. And another thing that Trump said in his speech in Davos, actually, that Ryan alluded to, he referenced the stock market on the stage, saying he thinks the stock market's going to double. If you needed a better piece of evidence that he uses the equity market as a gauge of success. Like, there it is. But it is going to give people pause for thought, I should say, about other US assets, whether that be treasuries, whether that be the dollar, whatever it may be. And then the question is, what do you buy instead? You've obviously got government bonds elsewhere, but there's a litany of issues on the fiscal front across the globe. And I think that's really why the bull case for metals is still such a strong one, and why we see gold on track for its best week since COVID. And I mean, I feel like silver's probably going to print $100 while we're on the call, the way it's moving right now.
Is that kind of, is that quick? I get it that there is nowhere else to go in reality in any kind of great size, but there is there is a confidence issue. I think we've got there. I want to move on there because we could talk about this all day long, and we'll come back to the US shortly because we'll have a look at what's coming up next week. But turning to the UK, talking of basket cases. We had a raft of data out this week that was rather telling and gave us a bit of an overview of the situation as it is. We saw UK inflation data that ticked up for the first time in some 6 months. We saw 3.4% headline year over year, from 3.2, I believe. We also then had labour data out this week and retail sales that came in and was a little bit surprised on the positive side. And then we saw Q4 GDP outlooks be revised as well. I've got a note here from Deutsche Bank, who says revisions have made the UK outlook a little brighter. Last week, the bank raised its Q4 2025 GDP growth projection by 0.2 percentage point, and they now expect the economy to expand by 0.2% quarter over quarter. They've also tweaked their 2026 annual real GDP growth forecast from 1.1 to 1.2%. Mike, where has UK data this week left you in terms of sentiment?
Yeah, it's an interesting one, really, because actually the data's kind of got better as the week has wore on. We started with the jobs data on Tuesday, which was pretty ropey, if we're being honest. Yes, unemployment held steady at 5.1%, but the PAYE payrolls metric fell for a 4th month running, and the size of the fall was actually the biggest since the back end of 2020, just when we went into our second COVID lockdown, which isn't a great historical parallel that you want to be drawing from. So the labour market slack is continuing to emerge there at a pretty rapid rate. The inflation side of things, I'm not especially worried about. There were a number of one-off factors that pushed CPI higher in December, particularly when it comes to tobacco prices, which were a result of changes made in the budget, and also airfares. They were up 30% month on month simply because of the time that the ONS did the survey. I think the data that's really interesting is what we've had today, because we had a much better than expected retail sales print early this morning at 7 o'clock, which is in line with what has actually been some really positive trading updates from some of the UK retail names over the last couple of weeks. And then those PMIs, the manufacturing number, a 17-month high, services and the composite gauge at a 21-month high. I certainly don't know where that's come from, and it is a sentiment gauge, so do take it with a bit of a pinch of salt. I think it's too early to say that the economy is turning a corner, but you would argue that if that does start to translate into improved hard data, then maybe we have been a little bit too downbeat. I mean, one swallow doesn't make a summer and all that, but we're sort of ending the week on a bit of a brighter note than we started it, I guess.
Yeah, well, there is a bit of a caveat with this retail because the underlying picture was a little bit less glamorous, really, on 3 month over 3 month, a bit more tepid. But again, the CBI business optimism tracker, that was up some 12 points to -19. We saw CBI total order books also beat expectations at -30. So there were some signs there that we were looking better. GfK, the consumer confidence tracker, also moved up slightly to -16, its highest reading since August of 2024. Ryan, have you done anything in sterling? Is that a particular currency that you're focused on at the moment?
Yeah, well, I'm still short via long euro sterling. I was expecting this reaction from retail sales. I thought we might have seen a bit better in November, but I think I said it on the last time we were here. I've certainly been saying it in our chat room and so on. Given everything that's gone on with the budget and the state of things, there's a possibility that everyone's just gone, sod it, we're going to be paying out our noses next year. Let's just blow out for Christmas and have a bit of a spend up. That the PMI data that was surprisingly positive. Again, services are jumped, quite high, and again that could be an effective end of year. It's got to continue though. The risk now is that it falls off a cliff in January and February, and even within those PMIs, everything looked rosy until you look at the job metrics, where jobs are still being shed at the same pace. There's no positivity coming out the jobs market. Wages are still a pressure. Skills are still a pressure. So none of the real underlying factors that make me bearish and have me bearish since July really have changed. But I'll be guided by the data, and if we maintain this pickup, if jobs continue or don't fall off a cliff and start recovering, if these PMIs translate to hard data, as Michael says, then maybe the UK is going to avoid some pain in the next couple of quarters.
But you sound fairly skeptical really at the moment, and just like you say, data dependent.
Yeah, I am skeptical. I'm going to wait and see what next month's numbers are like.
Yeah, no, fair enough. Moving on to Japan and Bank of Japan. Obviously, you've got, if anyone doesn't know, there's election on the 8th of February. I think they
8th of February
for the elections. Takeshi wants to just really cement her current position and favoritism in the polls at the moment, I think, by holding an election now. Bank of Japan kept rates on hold as expected. In its outlook report, it kept a cautious stance through its October report, and it returned the view that underlying inflation will remain around target throughout the forecast period. According to JP Morgan, they say the main focus on Governor Ueda's press conference, but he did not clearly signal an acceleration in the pace of rate hikes, instead maintaining the approach of assessing data at each meeting. Where do we see the Bank of Japan? Is it really one of those just is staying the course, it's doing as it was projected to do, Michael?
Yeah, I think that's exactly right. I think the only problem is that the market wanted more. We kind of expected the Bank of Japan would just stand pat and remain relatively coy in terms of the timing of another hike. The line they love to use is, if the outlook is realized, we will raise rates further. The market wants a little bit more of a definitive time frame around, when are you going to have the confidence that your outlook is being realized? Is it going to be early in the spring? Are you going to wait for the wage negotiations to take place? Are you even going to wait until further into the summer? And, Ueda didn't really say anything in terms of an explicit timing of that next rate hike. And because participants didn't get that, despite on the face of it, what you could say was a relatively hawkish decision, with that one dissenter for a hike and also an upgrade to the forecast profile, the yen obviously weakened pretty significantly in the aftermath of that and during Ueda's presser, because he didn't lean into any sort of concrete guidance around what and when they're going to pull the trigger next. And of course, after that, we saw the yen fall off a cliff in what could have been a rate check from the Ministry of Finance. It could have been, traders getting a little bit jittery at this stage. We don't know. But certainly, I think one of the big stories of the week that's gone maybe a little bit under the radar because of what's been going on in Davos is just this ridiculous volatility we've seen in Japanese assets. On Tuesday and Wednesday, it was JGBs. Today, it's been the yen. We've got 2 weeks to go until election day. Is this sort of thing going to carry on, I guess, is now the question.
Yeah, I mean, Ryan, I know you said that markets often get ahead of themselves with expectations for the Bank of Japan. The Bank of Japan has its own playbook and it sticks to it. Is that you retain that view, I suspect?
Yeah, I do. Could he have been a slightly more positive about things? Yes, I think it was a slightly less hawkish, more neutral comments from him compared to the last meetings. Michael mentioned about not set a time. He did say, though, that if they're going to judge what prices are doing in April before they think about another hike, which obviously one could say, well, they're going to wait until then, but also that's the time when they're going to know all these wage negotiations and how much that's going to go through and affect things. So I'm still favouring that they could go again this quarter. maybe towards the end or beginning of next quarter. It's a bit of a wide window. But then on the other side, he said, we're still expecting inflation to drop below 2%, all these cost push pressures coming out. And he said they were uncertain about how long it would stay below 2%. Well, the mandate and the promise is that they want stable inflation at 2%. So that would suggest they're going to be waiting a bit longer. But yeah, overall, yeah, there was two sides to the coin over this one. But yeah, the market, when you've got a central bank that is moving in one direction, the market always wants to know when the next move is going to happen. And when it doesn't get it, it was a green light for yen sellers to come in. And yeah, they've definitely been given a bit of a shake up after that move that we got.
That's a very good point, actually. Like you say about markets, we are in there's only one direction of travel for the BOJ, and yeah, people try and force the narrative, I guess, on that front. There was a note from Barclays actually, and this was before the break decision. Said yen rates shaken by fiscal concerns. Yen rates have bear steepened rapidly ahead of the lower house election, likely reflecting concerns about fiscal discipline. While the authorities' response to the sharp rising yields is a focus, the associated risk of yen depreciation means caution around FX intervention is likely to persist. So that's a note from Barclays that they put out again ahead of the Bank of Japan yesterday.
I also think it's, and Ryan, you can probably give a bit of colour on this as well, but I think what we saw this morning in terms of that 200 pip move lower on the back of whatever it was, let's call it a rate check, that's likely what it was. It does feel like that has changed the risk reward now from a yen perspective, because it's clear that we're sort of around these levels that the Ministry of Finance are getting very, very interested in. So actually, is the risk reward there now to be short yen when there's a risk that you could be 4, 5, 6% offside as and when policymakers do decide to enter the fray? So from a psychological perspective, that little slack down that we had this morning probably is making people think twice about piling back into the positions that they were in, this time yesterday.
Yeah, absolutely. And I think until we know what exactly gave us that move down today, then it's going to remain nervous. I mean, we'll probably find out Monday. There's some things we can look at the Bank of Japan. Can't remember what they're called now, but to do with the finances and
daily account balances, always.
Yeah, those sort of things. So you can get an idea whether they did or not. But I think if the market gets a whiff that it wasn't anything official, I think it will take yen pairs back up again. But in the meantime, we're sitting right here in the middle.
Okay, fair enough. Staying in the region, I guess. Mainland China GDP, it came in roughly in line with estimates, but we saw healthy export-led growth, really, both on the trade front. There were good imports and export numbers there that helped the healthy numbers for China. Has China turned a corner, or is it just masking further issues, Michael?
I know what he's going to say before he even says it.
Go on.
The validity of Chinese data.
Yeah, you got it in one. Yeah, absolutely. Can we actually believe what they're telling us is the first question. If we do take it at face value, then it does look relatively positive. Although, again, in conjunction with those Q4 GDP numbers, we also got the December activity stats, and they weren't exactly great in the bigger picture because, of course, China is trying to move towards a more westernized economy in terms of a consumption-driven economy. And actually, pretty much all of the output in December came from industrial production. Retail sales were higher year on year, but not to a particularly great degree. So I think
services was strong, I think.
Yeah, so I think in the grand scheme of things, maybe China is starting to turn a corner, but fundamentally there are significant issues that remain, and these are sort of more structural headwinds from a demographic perspective. And of course, the other thing is, Trump is clearly throwing tariffs around once again. The relationship with China seems to be relatively steady at the moment, but how long is that going to last? And is that another risk that could cloud the outlook? So a lot of moving parts. I wouldn't be overly comfortable on sounding the all clear just yet.
Okay, fair enough. Let's turn to the week ahead now, because we've got an interesting week to come, really, and it's headlined by the US Central Bank, the FOMC interest rate decision. I mean, widely expected to keep rates unchanged at this meeting. But we have a new potential new Fed chair. Well, not potential; it's going to happen. New Fed chair incoming. Michael, on the US interest rate narrative for this year, nothing's really changed since the December meeting, no?
No, absolutely not. I think the Fed are very much in kind of wait and see mode. They obviously delivered 3 back-to-back cuts at the back end of last year, and they just want to see the impact that that has had. Has that provided enough sort of support and insurance against downside risks in the labour market? And also, they will want to see further downward progress on the inflation side of things. So I think the path for the Fed funds rate in terms of the direction of travel is still quite clearly lower. It's just a case of when that next cut comes and what triggers it. And I think it will either be a further deterioration in employment conditions, probably a new cycle high in the unemployment rate. If we were to get that, then another rate cut would be on the table. Or if that doesn't happen and the labour market is stable or stable enough throughout the first half of the year, you're then actually talking about at what point in terms of the inflation side of the mandate are policymakers comfortable in saying, we think we're going back to 2% now, we think we're going to get to 2% consistently, we're happy to take the Fed funds rate back to neutral, because we're still 75, if not more, basis points above where you could reasonably put the neutral rate in the United States. So there is more policy restriction that they can remove, and I think they will want to remove when conditions allow.
Well, I think most people are still pricing in 2 cuts this year. I've got a Danske piece here that says they're forecasting a cut in March and in June, slightly ahead of market pricing. They say the Fed will not publish, as you know, the Fed will not publish updated projections. So the focus is strictly on Powell's remarks. We do not expect any new guidance on the reserve management purchases or other balance sheet considerations. As a trader, then, Ryan, I know you're more long term than short term, but obviously you'll have an interest in what happens next week. Um, do you leave your positions alone and just wait? It's a wait and see process for you. Is that the case?
Because I don't think there's going to be too much coming from this one, purely because they're going to sit on their hands. They've still got an economy that's ticking along. They've still got a jobs market which has been softening, but it's not falling off any cliffs. They've got inflation that's still sticky. They managed to get it down to the low 2s last year, but it's been up ever since. That's going to be the worry for them, their dual mandate. So they're in a bit of a sticky situation. Do they give the economy a little bit of a boost? Maybe aid the jobs market a little bit by another cut. I'm not saying at this meeting, but soon after. Or are they going to be worried about inflation? Because this is something that we're seeing in a lot of other countries, and particularly the market. Last part of last year, the last couple of months last year, we had this switch where markets are suddenly starting to get a bit hawkish. We're pricing in a rate hike for the RBA on the 3rd of Feb. The RBNZ are now getting into that boat. The Bank of Canada, starting to think about whether they're going to have to turn to hikes. So some of these central banks haven't even managed to get their rates down or inflation down and sitting around where they want them to, and we're already going back in the market into a hike cycle. So it's not going to take much for some real hawkish pricing to come into the Fed. If they do produce good GDP numbers, if the jobs market turns around a bit, we are going to be knocking out rate cuts and thinking about hikes again. And I think that's something that Powell's got to steer his way through next week, because the market's always looking ahead, and he's got to look to keep feet on the ground now.
Well, that's going to be a fun one, isn't it? Trump's Fed chair talking about rate hikes.
Yeah,
exactly.
I can imagine that ending well.
He'll be sacked a day later.
Like this way, Trump himself this week projected Q4 GDP growth for 2025 at 5.4%. That's running hot. And why would you need to keep cutting rates if that's the case? You've got growth of about 5% in a world that's not really seeing growth in the major economies anywhere near that kind of level. So
and you've got the currency coming down, which is potentially inflation boosting as well. So yeah, who knows?
Indeed. We talked about Canada and Bank of Canada. They've got an interest rate decision. You're going to pay any mind to that? I'll start with Ryan this time. Is that something you're you'll look at just as part of your portfolio?
Yeah. I mean, I like trading dollar CAD. We're coming down to some interesting levels. If we get down into the sort of the low 137s, particularly down a bit further, 136s, 135s, that's where we made a bottom for the year's drop last year. So yeah, it's going to be interesting. Again, I think this is a communications meeting with the, as I say, the market. Not wholesale, but some of the market turning a little bit more hawkish or less dovish on the bank. They themselves are in pause mode. Inflation again ticking up a little bit. So I think they've got to communicate, not letting the market get too hawkish over what they're doing over there. But on the whole, I think it's going to be a pretty flat meeting, pretty neutral meeting.
Yeah, fair enough. We've got Riksbank interest rate decisions for the Swedish central bank set to meet as well. In terms of other data for the week, Australia CPI will come in on Monday, and it's again there's a Melbourne Institute survey that showed near-term inflation expectations picking up to around 3%. This should worry the RBA a touch if it continues that way. I think
that CPI data is probably going to be absolutely vital for what happened at the February 3rd meeting. They've even said about it. Bullock herself has said about it. And I'm sorry, just to jump in, I'm wondering whether the market is perhaps a little bit too eager to see a hike at that meeting, despite how bullish Bullock has been sounding. But I think that CPI data might be the icing on the cake or not.
Awesome. We also got Eurozone flash GDP. We've got the France and German flash readings as well on the same day. I don't think we're likely to see anything that will reshape the ECB's narrative, Michael. Do you?
No, I think the ECB are done and dusted, to be honest with you. And if they are going to cut again, it will be because inflation undershoots the projected levels over the next couple of years and not because of anything on the growth side of things. So, yeah, I don't think Q4 GDP numbers are really going to be a particularly big game changer on the Eurozone front. And actually, given the narrative around this year, which is built largely on a positive impulse coming from fiscal stimulus in Germany, I think it's early indicators from this year that are going to be much more important in driving things for the ECB and for the euro.
Yeah. But talking our lunch bet again, I see.
Well, I'm not going to talk someone else's.
Remind us of the lunch bet. Remind us of the lunch bet.
I think the ECB have the potential for another cut this year.
Interesting.
And I don't.
Yeah. Well, yeah, you and the rest of the market.
And we'll both be wrong if they hike.
Yeah. So in which case, I'll buy lunch if they hike. No, I won't. No, I won't. I'll just
it's recorded. We've got it on tape.
It's true. It's recorded. Okay. And just to round off this episode, then geopolitical risk. Again, the French budget. There seems to be a bit of movement on that front in the near term. I think they forced through certain aspects of the spending bill this week. But do you still see that as on the periphery of worries for the euro area at the moment, Mike?
Yeah, I do. I think there's going to be a lot of noise around no confidence votes, although the government should survive those. I think also just geopolitical risk more broadly. Shameless self-promo. I did write a note on this yesterday. What does Trump do next? 2 weeks ago it was Venezuela. Now it's Greenland. One thing we do know is that the guy doesn't like to be out of the news agenda for very long. So where does he turn his attention to? Obviously, things are still kind of simmering away in the Middle East. There were some reports doing the rounds earlier this week about wanting regime change in Cuba by the end of the year. Various other Latin America countries, potentially Colombia, things like that. So, geopolitical risk, I don't think is going to be simmering down or going away anytime soon.
You've missed the big one. We've still got a potential shutdown at the end of this month.
Oh, government shutdown. Yeah, that's a good point. Yeah.
Well, he's on a legacy tour, I think, at the moment for the next 3 years. So
if he's miles,
if you're naming the Eiffel Tower the Trump Tower at some point, I think.
The Trump Tower.
You joke. I thought I'd heard a lot of things in geopolitics over the past few years, but it's constantly amazing me what we what we're hearing really at the moment. So
Love it. Absolutely love it.
well, again, it brings a little bit of volatility and a bit of frisson to the markets, which I think at the start of a year sometimes can be lacking because everyone's still bedding in and just looking at their books and budgets and stuff like that. So it's quite interesting from that perspective, really. Listen, we'll come to the end of our time now, guys. I'd like to thank you both very much for your participation today.
No, thanks for having us, man.
Awesome, and we'll obviously we'll get you back on again in the near future to cover, say, the Bank of England and so, because I know you have a few things to say about the UK economy and so forth. But thanks to Ryan Littlestone of Forex Analytics, thank you,
Cheers, mate. Thank you very much.
and to Michael Brown of Pepperstone Brokers, thank you, Michael.
No, thank you, mate. Pleasure as always.
Awesome. I'll put up the links to where you can find our two guests for everyone later on, and yeah, so you can just see there. And again, I'll put these links up so you can find them online. But thank you both for your time. Thank you guys for listening. We went out live, but anyone who's missed the start of this, you can find us on the usual podcast platforms and on the social media platforms, X as well as LinkedIn, amongst others, and YouTube as well. So please subscribe and just get your weekly dose of the market talk. But thank you again, and have a great weekend. Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.